Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Friday, March 28th, 2025. It is 10:40 a.m. Eastern Time. I'm starting the video, so we'll start out with the equity markets. Time permitting, I'll cover some of the other things I've highlighted recently. But let's start there on the stock market. So we failed to break out of those bullish falling wedges. Remember, a chart pattern, bullish or bearish, is an untriggered pattern waiting for a buy point. So they didn't even come close. They didn't even give it even a punch in a failed breakout. So what happened? We went down, but we are now at support. So this is probably where we get the first bounce today or reaction. But chances are reactions at this point, they're going to probably start selling a little more aggressively into the rallies. And it wouldn't surprise me if we get to that point where they just start having very little, if any, reactions off each support level. Either way, a reaction I define as one of two things. If you're new to the site, if you've followed me for a while, you've heard me say this. If you drop a, let's just say well, let's say that was a hacky sack and this is a golf ball. You drop the hacky sack on a floor and it's going to stick. It's going to stop there, but it's going to stick. And if you drop a golf ball or a ping pong ball, it's going to bounce, right? And so that's a reaction. Now, at this point, where we're at and everything, I do not expect, I think this is probably that was the preferred bounce target was going to be it. And that was also the 200-day moving averages. And so at this point, especially with this failure of that nice potential bullish falling wedge and the uptrend line, that's where we're at this morning. That's why I got out to play out. It didn't play out. You can see what happened. Let me zoom in. Hopefully you can see this. We went right down through the uptrend line off the lows, and that's bearish. So this is the reaction. We've stopped there so far. It's right as I start the video, so you'll look at 1 minute candles. That's the same level. There's the low. So there's a reaction. It's minor so far. May get a little more upside. We'll see. Look, anything is possible. We haven't taken out the lows recently, the previous lows. But if we do, the way it works is this is support. It's a level. You've had it on even the chart this morning, last few charts. Let me trying to move it, and I'm trying to move the annotations there, the TL. We still actually have that divergent low, by the way. And again, divergence is not a buy signal. I always say that, just like overbought or oversold aren't buy and sell signals. But that's it. So the case is still there that we could rally, but we're below the 200 days. So again, now you want to look for, as we've been doing, rallies back into resistance to short until unless they clearly take back the 200 days. That's a big level right there. You can see all the resistance levels. So like I said, we've exited the target zone in the VIX. Of course, if we have a reaction here, which we do, so well, I'll do is micromanage, take some, add to those VIX longs earlier when I got the post out to you right before that. Take a little off here, take some of the index longs off. In my active trade account, I'll gain a little bounce, but again, I'm not looking for a whole lot. Max bounce target right now here, up to about here. And if we just turn around and break, then time to be short again. We're probably going to go down there, test, and most likely break that level. Again, this is, and I try to caution you, don't get too lost. It's easy to get lost in the world of the intraday charts, the 15-minute, the 5, the 60-minute charts. That'll help kind of, time entries, exits, the near-term stuff like I'm looking at here. But then we go to the big picture. And this is the big picture. And this cannot be underemphasized here. Everything that's happened, again, I don't want to be repetitive, but I know there's new folks coming to the site. We had the multi-month trading range, the divergent high, marginal new, failed breakout. The futures failed just like they did back in November with the in 2020, late 2021. Put in almost an equal high, but failed to make, for all intents and purposes, equal highs, negative divergence. As anticipated and expected at the time, that breakout would fail, and then it would be followed by a swift move down to and below the trading range. Check, check, check. So those are massive check marks. Then the almighty 200-day moving average is clearly taken out and recently tested. So yesterday it seemed almost too easy. Somebody asked, hey, is it an all-in moment? And I said, I really, it almost seemed too easy. It's just so textbook, and it still feels a little bit almost too perfect. but sometimes, I'll even over analyze my own analysis of, it's almost like a trap. They say some animals like coyotes are cunning and very hard to trap because you put a little piece of meat in the whatever in the trap, and it knows, hey, that's not natural. So, but look, it is what it is. This was just a textbook break so far in rejection. And again, you can see, I'm going to move this line right here. This is the same level I showed you on the futures a second ago. Let me color it up. It's de-highlighted. So that's it. And then, of course, the last support is right here. These are the lows. We haven't been to that level since here. So we're getting in the point where, and I still, somebody asked, is that he asked on the S&P. It's not a textbook bear flag, but for all intents and purposes, it has a similar effect, an impulsive leg down, an area of consolidation on decreasing volume as well, not by a huge amount, but more so, they take that out, it's just nothing but bearish. And again, this is a daily chart. We look at the weekly charts, and this is why I do these videos. I want to convey to you, as I have recently, if you think what we've seen so far is just, oh my God, Randy, Nvidia, Tesla was down almost 60%, and Amazon, Apple, and you look at all these, how much further can they go? Again, this is the important part. This is why I share with you my years of experience. That's nothing. This is just a little blip. And this was one of the more mild bear markets we've had in history. And in fact, I still maintain this is just really an initial leg down. Sometimes you break down and you have a little kickback rally, it falls shy of the highs. Sometimes you break down, you have a marginal new high. And so again, if we are going to my targets, try to put things in perspective. There's a lot more downside left here, and we haven't seen anything remotely close to a market crash or even a meltdown yet. It's been a nice move down, and that's it. So we could easily, as I said, head on down, and it wouldn't surprise me. We've already hit my first and second targets from last year, and this is still the next target, and then T4, T5, T6, T7. We're not going to go down to beyond, in my opinion, T4, even if we had a mini crash-like scenario. That would probably be the maximum right there. T3 is the next target. Remember, we already had check marks on T1 and T2. So I don't think we'll have much, if any, reaction now, especially if this flag-ish type pattern does play out in that fashion like that. That's going to take us down to T3 right there. And so I want to, here, let me measure it for you. So from yesterday's highs when we were testing the 200 days, that's going to be a drop of another 15-16%. And it can happen within a week or two. That's how fast you can drop 15-16%. So, all we can do, and look, this can be a little whipsaw move. They can rally the market up. Anything's possible. I'm not going to tell you otherwise. We all know that. You don't need me to tell you anything's possible. I talk in probabilities. But again, I just want to paint the big picture, as I've covered before too. Recently, we had a PPO histogram, a very, very reliable indicator right here that defines bull and bear trends. I've covered this many times in the past, including recently. That was the last bear market we had. The one before that, it was, if you blinked, you missed it. It was called COVID. It was a 36% drop in the S&P. That was the last time, with zero exceptions, guys. You're looking at, these are green bars, bull markets, bear markets. And then the Q4 drop in 2018, top to bottom in many indexes, many stocks was a drop. You can see top to bottom in QQQ was over 20%. So if you want to use the old definition of a 20% drop, then that was a bear market for QQQ. SPY fell a little shy of it. And again, that was the only other time in recent years that we had the PPO histogram read. So that's it. We got that crossover there. That will be finalized on Monday if it's going to be. SPY has just now crossed. Remember when I did this update about a week ago, we hadn't yet done that. SPY right there, negative 0.2. And that will be finalized if unless the market rallies between now and Monday and closes up quite a bit. You're going to have the bearish crossover on SPY. Last time was right here. So if you waited again to that monthly cross, and even if you wanted to be a purist, meaning this is a monthly chart. All that matters is a monthly close. So at that end of the month, right there, there's a red candle. I'm going to grab the bottom of it. You waited then to short. Well, you were able to profit 20% on SPY. And remember, more on QQQ, I believe, on that drop. Yeah, definitely more on QQQ. Or you sidestep that. Maybe you say, Randy, shorting's anti-American. It's bad. Don't do it. Whatever. But you would at least sidestep from that point, when you got the signal on QQQ, a 30% loss on your most people are in these tech stocks. Some people have just all S&P 500 funds, but most people are loaded up on NVIDIA, Apple, Amazon, NASDAQ 100. So that's really the losses that masses would have suffered there, about 30%. Again, not from the highs. I'm saying from when you got the bearish crossover confirmed on the PPO. Okay, so that's it. We'll see how today finishes, of course, and then how we trade into Monday. I'm going to guess, unless we have some mega rally, and that's possible, guys, anything. Again, I'm going to keep saying it. Watch the levels. There's the downtrend line. The divergence is still intact. It's more of a price channel now, but still positive divergence on the 60-minute chart. That is good support. We've had a lot of reactions there. So if they rally it up here, and they pop that trend line, we could see a decent rally. But if we don't, if we see a decent rally, look, I'm going to just be straight with you. Unless we gain back the 200s, and I keep kind of talking about the short-term stuff and the long-term, we have more check marks than I've seen in years to be short on the long-term, on the swing trend short trades, and I've maintained that all along. This is just realm of the active trader, this stuff here. Unless the S&P 500 and the NASDAQ 100 get back above their 200s, and the majority of Mag 7 stocks. Let's not forget, that's what I cover. I go over all the time. I'm going to just turn off all the lines and just rifle through them real quick. So there's QQQ. You don't have to squint to see, are we below the 200s? There's the 200s where we're clearly below, rejected. Apple below the 200s, rejected off the 200 exponential last 3 days, testing them and now rejected. 200 simples well above there. So there's one, the top one, the most important one below the 200s. Microsoft, it's not even close. Here's the 200, the red and blue lines up there. NVIDIA, well below the 200s, rejected off the 200 simple moving exponential, the red line, after several attempts to get through it. And boom, boom, boom. So, this is what I've been talking about collectively. For months, I was saying when I see the majority of the Mag 7 stocks below the 200s in the indexes, that's it. That's your aggressive. And the last couple days, yesterday when I just wanted to just see a little more convincing that this wasn't just some perfect little setup bear trap situation. And I think the odds for that now are quite a bit lower, and will be much, much lower once we take this out. We'll probably start to have a pretty strong meltdown there. So, like I said, this time to get maybe not fully aggressively short until these levels I just gave you earlier. Again, I should use QQQ. I know a lot of you guys and gals don't use futures. They're right there, but it's about 472.50. You can see a lot of reaction lows. The trend line was taken out and the stops were hit. That's the next level, and the final straws, these recent lows. Doesn't mean there's no guarantee that if you break that you can't drop a little and then reverse. All it means is there's no support below there, at least not for a long time. When you look at a daily chart, this is a daily chart. If you put the lines up, 46, about 466, it's really not even that good. So it's only the recent lows is why I have that line there. And you can see there's really not a whole lot there. At that point, I turn back to the weekly chart. So that's it, guys. We're there right now. We're at support. They're dancing on it. As I said, they hit it. There's your hacky sack reaction right there. Not more of a reaction in time than in price. That's what I'm talking about. This is a reaction in time. When you're dropped, you hit a level and then you kind of stay on that level for a while and then break it. That's the more bearish of the two. That's a reaction in price when you bounce and then go down. And so far, we're just thud. We hit that level. Again, buy programs, humans and machines will buy at support. It's going to give you a little hiccup. But again, I want to caution you as we start to hit that, if this bear flagish type scenario does play out here, I'm going back to the weekly. The nature of a bear flag is three components: the initial leg down, the move up followed on declining volume, a little kickback rally that takes the form of flag, and then an equally impulsive move down that typically matches that drop. So this is what you'd be looking at here: 3 weeks of red candles. And so at that point, you're not going to see many 5-15 minute chart setups from me if we break the recent lows. It's just kind of all in short moment. You know, not all in is your number, not mine. It doesn't mean every penny in your account. It may. I mean, it depends on who you are. I like to spread my bets, but and I also have different positions, different asset classes. I don't trade just the indexes. I don't trade just crude oil or just natural gas at any point in time. I usually have other positions. All right, enough on the markets. Let me just cover SPY for you real quick. ES for UES traders. There was that wedge I gave you this morning, failed to break out, so no buy signal triggered. And we just dropped same level. I mean, when I say same level, super well defined, these reaction lows. And that's why we pause there, break that, then there's just not a whole lot of support for the S&P 500. And although it's not my preferred trading proxy, why? It's simple. Right now, you can, you're either going to be right or wrong on your calls. You're making 1.5% if you're short SPY, or you're making 2% if you're short QQQ. It's super simple. QQQ just goes up and down in a multiple of the S&P 500, unless the banks have a problem. 2008 is a good example. Financial system collapse, the banks collapse, and it actually went down lockstep. They were both, even though QQQ, they both went down about 57% in that bear market from high to low. But usually you're going to have a much bigger drop in a bear market in QQQ than in the S&P 500, because the S&P 500 is full of grandma stocks. It's got steady Eddie utility stocks, healthcare, defensive issues, dividend paying stocks. And the NASDAQ 100 is just a very tech-heavy index, higher growth companies. And high growth companies do good in an expansion in a bull market, and they do much poorer in a bear market. Let's just wrap up with VIX. You probably want me to wrap this one up. This one's been spoon-fed. We were long there off the lows. Said on a couple occasions there that VIX is cheap, showing you it was at the low end of its trading range, and it was one of the cheapest, and it's still cheap. I want to say that right now. If you want to know, like right now, a good trade with nice RR, this is the VIX, and that's why we started scaling back in. The color I had there was colored in on the screenshot. I don't have that box tool here. You know what? I could actually do it. I just kept coloring that in before. That was that scale in zone I gave you last week. Told you we hit T1. Odds were likely to get a reaction pullback. So we milked that initial leg up, reversed, and this was the scale back in zone I told you I started doing last week. And we went down to about the bottom of the zone, and we exited that zone today. You can see a clear trend reversal in the VIX. So if the next support levels on the indexes break, and again, look at where the VIX is. The VIX is still down. This is obviously the VIX futures ETF. This is the actual spot VIX. Now that's going up a little bit. If you want to know why the disparity, again, if you're new to the site, because I say this often to my existing subscribers, you can't buy the VIX. The VIX Volatility Index is a methodology. It's an index. You can read about the methodology. It's calculated on put call buying on the S&P 500. You have to trade derivatives on the VIX, and those derivatives are the futures, the options on those futures, or the ETFs and ETNs that will roll the futures and use those. And so you can see the VIX has steadily been moving higher. And but VIXY, you're going to have expenses decay. I personally like to trade VIX futures, but this is an option if you don't have a futures account. And it's a proxy I've been using for showing you that trade. So there it is. And I just wanted to show you that, last time around we were long right there, same time, right at the lows, right before the breakout of that wedge. We milked that, gave you a third and final target up there. And that just trying to show you again what the VIX can do. So back then it was 100 and what was it? 100 and over 130% or so rally from the low to high. And so far, right now, from the recent low, we already hit that first, we milked that first 40 something percent. But right now, look where we're at. We're only 20% above the recent lows on VXY. And if you look at VIX, and you go to the weekly chart here, covered this many times. This is where bear markets end. Real bear markets. Again, I don't consider 2020, it was a bear market in 2022 by all definitions, but again, I think it was the first leg down in a new bear, and we didn't even get to where bear markets end. There's where the financial crisis, 2008 meltdown, that's where the VIX peaked. That was COVID, certainly a bear market, 36% drop in the S&P 500 in just 6 weeks. And this is just where corrections ended. And so I still view 2022 as a correction. And so look at that. There's a lot of meat on this bone, guys. If you want to know the single trade that has the best RR, and again, it's RR. It's not just upside potential. The VIX always has a lot of upside potential. When it moves fast. But as I've been harping on, when I say when I said before the VIX was cheap, and that's why I liked scaling in last week, even when I was gaming longs on the bounces, because the downside was dwarfed. I truly believe that even if we punched back above the 200s for a little bit, the VIX would have been less responsive. You're going to have that elevated. The markets are still, some long-term sell signals, and so I saw downside as being very limited. And again, that's about to where it was. That's why I gave you the scale back in zone. So that's it, guys. Trade it as you want. Be careful with the VIX. She moves fast. You don't need to put a lot in there, to make a lot of money. And that way, control if you want to try to quantify how much you can lose. Well, if the VIX plunges back to or below the recent lows, it's 18% down from where we're at today. Now, if you scaled back in here from the recent lows, it was only another 7-8%. That's why, last week I said that, it's time to get back into the VIX, because the downside, if it just, let's say, because this is where the stock market was at all-time highs right here. And so to do, if you just assume that VIXY would go back there, then you had 7% downside to my next target, 150% upside. Okay, that is a phenomenal RR, risk reward, meaning you're risking 7-8%, let's just say, if that's where your stop is or whatever, to make 150%. Take that trade out. These are once, I'm not going to call it once in a lifetime opportunities, but you don't get these opportunities that often. And again, just because the upside potential is so high, don't just see dollar signs. I can't guarantee anything, especially that we're going to go there. But I also wouldn't be surprised to see us blow past there. Again, because the VIX, if we are in a bear market, it's not been priced in. That's the thing I've been harping on for a long time. Credit spreads, I've said for a while, are not pricing in the risks in this market. And then the VIX too, being at the low end of the range, this is where we started buying it recently. To get back to where it ended the previous bear markets, that's 722% run from that recent low back here, and we were long off that low before, but we had a couple trade we closed out, for the reasons before hitting support in the stock market. That's when I think we came down and tested the 200 days before. All right, let me wrap it up here. You guys know the plan. It is as close to that kind of back to aggressive short moment. We already had the kickback rally. We broke the 200s. We tested them, and now we got rejected off the 200s. All we need to do now, take out the recent lows, and unless it's just some kind of wicked bear trap, and even if it does, look, remember, I view kickbacks now to resistance as I have before, including the 200s again, is objective shorting ups. Any kickback to the trading range is objective shorting up. As I've been saying for weeks now, and unless they get back up above that third quadrant or third, level of the, or maybe halfway up into the trading range, all arrows I see have us going down there. That happens, maybe something else is going on. I will address it at the time. I know the fundamental landscape can shift as quick as a tweet goes out, but there's, it's my call on this and outlook for the market had nothing to do. Didn't have even a Trump win priced in. It didn't matter who got in. The charts are the charts. This stuff was going to happen one way or another. Again, fundamental catalysts happen. May have been a different set of fundamental catalysts, but the technicals rule the roost. This market was overvalued, heavy, and the divergences showed that momentum was waning and a correction was coming. We just need to, or a bear market, we just needed to break the aforementioned levels, which have broken. So let me shut up here, wrap the video up, get it out to you guys. And then I'm going to add a little just side note before I do. Yeah, gold's been resilient for a while. Everyone wants gold because Bitcoin's no longer working as the Bitcoin heads, whatever the nickname for your crypto, those hardcore crypto fans saying that it was going to be an alternative to the manipulated financial system, blah, 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 and all that. And all it's turned out to be is just a risk on asset highly correlated with the stock market, and it continues to be. And remember, we still have swing trades on that, and that was a IBIT, perfect back test of the downtrend line recently, and this trade was shared on the 60-minute chart. I mentioned my preference and personal covering there at T3, expecting a bounce, and so we pretty much rallied back to the trend line, and now we've taken out this uptrend line. These are still the targets. Nothing's changed in this trade, and we need to now take out this longer-term trend line. If you want an update on VIX, I'll get to the futures. I'll get to Bitcoin, the actual crypto. Like I said, it's just going to follow the market. It's just a proxy on trading the stock market right now, in my opinion. But what I wanted to talk about is gold and silver, and say that, yeah, gold's had that just a resilient bid lately and kind of shrugging off. But we still have the divergences. And what will happen if we do hit that meltdown point in the market? Let's say next week is crash type scenario or impulsive selling. You might think, and it's possible gold gets a flight to safety bid, maybe in a blow off top, but you tend to see what they call a margin call unwinding a lot. Most traders at any point in time, I don't know the number, but I know it's in the high 90s, especially right after a peak of a bull market. Most traders on margin, when you look at the FINRA margin stats, which is how much money is being borrowed through a brokerage account where you leverage on your own positions, that's margin to borrow to buy more. Most of that's longs, bulls, loading up. They got a ton of Apple and Tesla and Nvidia and crypto, and they margin up and they buy more of it in a margin account. So the unwinding of that bubble, and a lot of those same folks probably own gold as well, and so you tend to see and we haven't, again, we are not in and haven't seen a crash type scenario in a long time in the market. If we get to that, you'll probably see almost everything with a ticker getting sold, except things like the VIX, things that go up inversely. And so gold may go down as well. Either way, the divergences are still there. There's silver. This is a 60-minute chart. Silver still has that divergent high, and will most likely roll down and silver more so. Gold's the main flight to safety bid instrument. Silver usually will follow gold, but I've noticed too in bear markets, silver usually gets taken down pretty hard. It also has a higher industrial component. Remember, gold and silver are both precious metals, but they're also industrial metals. They're used, gold and silver, many industrial applications. I think most of you know that. So therefore, when you get a bear market, which implies declining economic growth and or recession, you usually see the industrial metals, copper, silver, gold, and all that go down due to perceived demand destruction. All right, let me wrap it up here. You guys have the levels to watch. We're still flirting on that level since I started the video. Starting to crack it a little bit right now, not by a whole lot. Let's see if we can get a 60-minute close and then take out the lows. And at the end of the day, and I'll tell you this now before we get to the close, I'm feeling better today, so I should be able to do plenty of updates. I would be. I don't see. It's going to be interesting to see how many traders, unless we have a nice reversal today, and that's certainly possible if we hold this support. But it's going to be interesting to see how many traders are going to want to go home long this weekend. So you might see a dump into the weekend, even if we get a little rally. That would be a nice re-entry right there. You can see a gap right here. Price resistance around 480. as would a rally all the way back here. These are the levels on the 60-minute chart I gave you before. Remember, we already hit my preferred bounce target zone. That was the optimal reload entry point. We had a little bounce there. I thought we might get a little more out of it. Didn't. There's just no buyers on the other side of things right now. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.